right. Welcome, everybody. Thank you for joining us today. We wanted to take a minute, do things a little bit differently than how we've usually done them in the past. As you know, markets are moving. Things are kind of, one day the market's up, one day the market's down. A lot of people are asking us questions about that. Many of you we've had phone calls with. You've been in the office. We've had some conversations. We've answered a lot of emails. But we wanted to take some time and really go over things kind of in person with one another and talk through some different stuff that's moving markets, a lot of questions that we're seeing and we're hearing from you guys. You guys are staying busy. Sometimes it's hard to stop and make a phone call in the middle of the day to get a hold of us and things like that. So we're going to take a little bit of time here, go through a few things, and hopefully this is really helpful for you. We'll start off with Matt. Matt, if you'll kind of just lead us into talking about really what's moved the markets the last several weeks and the reason we're seeing some of the stuff that we are.
Sure. First, I'll point out that the volatility we're seeing really isn't abnormal. I know every time we see volatility like this, we think, okay, this time it's different. There's always some kind of doom and gloom, and a lot of that's perpetuated by the media cycles, which tend to be overwhelmingly negative. If we look at volatility in 2023 and 2024, they're at historical lows. We had a pretty off April last year, but we'll generally see 1 to 2 market corrections or 10% or more drops in a year. We didn't have any last year. We've already had one this year so far. Largely that's driven by tariffs. The tariffs is a big one. Interest rates right now is affecting the markets, and there's some geopolitical tensions that tend to get in the news cycles. They may not be affecting things quite as much, but they're still there. They're looming. I think really to talk to tariffs, I'm going to kind of defer that to Roger. He's sort of our expert on those things. He's his background's in economics, and he's studied this, learned this for quite a while. So I think he's got a good perspective on it.
Yeah, well, thanks, Matt. I think the market is really looking at tariffs from 2 different lenses, right? The first lens being that Trump is using these as a bargaining chip, right? Leverage, a tool to have a policy win for his administration. The second way he's looking at tariffs is really as an income replacement, right? Think of Trump's policy of, eliminating income tax for people making under $150,000 a year. The market looking at, those kind of tariffs, I don't think is favorable because when markets really don't like when the free exchange of goods is disrupted. So for the next little bit, we'll see pretty heavy amounts of volatility, a lot of swinging in ups and downs in the market, and I think that's driven mainly by, and I think you guys can attest to this, of investor sentiment not really knowing where to put the money, and new business growth not really knowing it will. For example, if I'm starting a new company, I want to know that I'm going to be able to sell my product in Canada at the same rate today as I will be in 4 years, right? So there's a lot of that going on. So I think in the next little bit, the predictability of it, or rather the lack thereof, is really what people are going to be trying to pay attention to.
And if you're a shareholder, and you're saying, hey, how's my company going to do this year? And the company's saying, hey, we really don't know, right? Because we don't know what the tariffs are going to be. That uncertainty. We tend to plan for the worst. The markets tend to reflect that, and the worst typically doesn't happen, and that's where we see some pretty good rebounds.
100%. I think you can see that really heavily with a company like NVIDIA, which has really twofold of their tariff controls on them. One, they can't export a lot of their goods due to export controls to China, and two, they're trying to bring a lot of chip manufacturing back to U.S. shores, so they're tariffing the manufacturing plants for the chips in Taiwan.
Okay. Right. Well, let's say the economy does slow down. Tariffs hit things, people stop spending so much money, the uncertainty. Is there something that the Fed can do or the government can do to kind of kick things back off and get things going back the right direction?
Yeah, so in the event of a slowdown per se, the Fed can always lower their interest rates. And I think that's more or less where Trump is leaning, right? On the other side of things, though, if consumer spending doesn't go down with tariffs and whether they are just maxing out a credit card or getting personal loans to buy things, what you could see is the Fed could increase those rates. But ideally what will happen is if tariffs are to take an outsized effect on the economy, the Fed can go in, cut rates, and try to stimulate some economic growth.
Sure. It's about raising the rates. They've added another arrow to the quiver, so to speak, of things to help.
Yeah, absolutely.
Keep the economy running.
Sure.
I think the other thing to note is usually when you see a correction, which is defined as a 10% drop in the market, they tend to be pretty steep and quick. They drop fast, they rebound fast. When you think of bear markets like we had in 2022 or back in 2008, those tend to be more of a gradual slow bleed.
Yeah.
And this has all the hallmarks of, good underlying economy for the most part, steep drop, sort of started the rebound. It's been a little rocky on the way back up, but this is kind of the textbook definition of what a correction would be, right? And,
Yeah, absolutely.
Should be short term.
Absolutely.
Jordan, is there anything that what are we doing, right? Like as a team, what can we do to help better the situation? Like where do we add value there?
Sure. That's a great question. So a lot of people have had the conversation, you've heard it from us before, and you've probably heard for years that, when the market's down, you want to buy the dip, right? Well, a lot of people kind of rebuttal with, well, if I'm fully invested, if I don't have a bunch of cash on the sidelines, I'm buying the dip, right?
Yeah.
Well, something to think about is when you're invested in a portfolio that has got some things on the more fixed conservative side, you've also got some things obviously in the stock market. What happens at a time like this is usually when the stock market's down, your conservative investments are up in value and vice versa. So when you've got one side that's doing better than the other side, we're selling the side that's a little bit overweighted and done a little kind of outperforming things to buy the side that's underperforming, so that when that side pushes its way back, you've rallied that back, you've made some more money. You're kind of making the best out of maybe a less than ideal situation, right? Some people view it as, but it gives us the ability to, all the while markets are moving the way that they're moving, it's not simply just sitting still and kind of taking the beating, as some people say, or just riding the roller coaster. There really is intentional things you can do through that process. So for us, it's really important that, we try to help you make sure that you're not making, really difficult emotional decisions when markets have moved dramatically. Because it's not, nobody has a crystal ball, nobody knows what's happening tomorrow, but trying to time the market very rarely works in your favor. And, there's lots of studies that show that by and large, you tend to miss the best moves that you could have made by trying to, miss some of the ones that you were trying to miss. So that's our big thing, is just really kind of doing that dynamic rebalancing as things are moving.
Yeah.
So
and lean on us, right? I mean,
100%.
We're not going to say no one should ever get out of the market in these circumstances. Everyone's situation is different, and it's all about your time horizon. But we're going to try to keep reaching out to you. We'll do video, we'll do with letters in the mail, like Jordan said. We've got all kinds of avenues that we're here to support and help.
Absolutely. I do want to add one thing. I think I've been getting these. You have, and you as well. Phone calls of which people are saying, hey, April 2nd, Trump is going to hit more tariffs, and there'll be probably more after that. So why don't we just go ahead and move to cash is the question. Jordan, would you like to kind of answer that one?
Yeah, well, I think, back to what I mentioned about is just, we just don't know what the future holds, right? What we do know is that over time, the market's a great investment. The market does come back over time. Sometimes it's, like Matt said, you have these quick corrections that can be kind of fast, kind of painful, but they happen quickly. You can have downturns in the market that last a little bit longer, right? But there's no way to know exactly what's going to happen. Sometimes good news is great news for the market. Sometimes bad news is good news for the market. It all depends. So we also feel that even if more the tariffs that are going to be announced, we feel that those are priced into the market quite a bit right now, because people know about them, they anticipate them, right? The same reason that we have people call us saying, the news, I saw that so and so bought such and such company a week ago. The price of the stock has went crazy. We should buy some. Well, a lot of times you've missed that big rally, right? It's kind of the same thing now. A lot of the market they're anticipating this to be bad at the beginning of April, so stocks are already reflecting a whole lot of that. So we don't feel like there's a drastic amount of downturn left there, just because of tariffs and things like that.
Thanks, Jordan.
So,
but you have the the black swan events, right? The geopolitical events.
Sure.
Mm-hmm. Somebody invades somebody, drops a bomb. Those are things that are sort of unknowns. But based on what we know right now, we should be fine for the next little bit.
Absolutely.
I used to early on when I was new advisor, late 2011, early 2012. I remember an exercise one of my training advisors used to do. He would keep a ruler in his desk drawer. And then if somebody would get real scared about the market or having a bad month, he would pull it out and he would say, "How far is it from here to your house?" I said, "About 8 miles." He would say, "No, use this ruler." And people would look at him kind of funny, but his point was, if you've got a long time horizon, we're going to measure that success in years, right? Not in days or weeks or months. And I think that's important to keep in mind here.
No, that's great.
Definitely. Well, cool. You guys have anything else to add? I feel like it wraps it up.
I think that should do it.
That's it. Just I want to reiterate that if you guys need to call us, we're not going to hide under a desk. Give us a shout, and we'll answer any questions you have.
Thank you.
Yeah. All right, guys.
Thanks, guys.
Hopefully we'll have another one of these before too long. Hopefully this has been helpful to you. So, like Roger said, if you need anything, reach out to us and let us know. We're here for you.
Thanks, guys.
Thanks.